Hey, Jeff Lerner here, and today we're going to talk about the infinite banking concept. Have you heard about this concept? It is super powerful, super cool. I've been doing it for over 10 years myself, and it basically turns you into the banker in your own life so that instead of having to borrow money from a bank, you can borrow money from yourself. Super cool, and I'm going to tell you all about it. Okay, so to understand infinite banking and what's called the infinite banking concept, there's a few basic principles that we kind of got to walk through. First of all, the advantages of infinite banking are really, there's two primary advantages. One is it gives you the ability to borrow money at interest rates typically way better than you would get for any sort of unsecured or uncollateralized loan where you didn't have to put up your house or your car to borrow the money. Usually you can get infinite banking concept type loans for around 4 or 5% interest rates. So obviously the second benefit is that you don't have to put up your house or your car as collateral. In fact, these loans are collateralized by the actual death benefit of life insurance. And so to understand infinite banking, you have to know a little bit about a type of life insurance called whole life insurance. Now these are policies that, unlike term life insurance, they actually accumulate a cash value over time. So when you first start paying into these high cash value life insurance or whole life policies, and let me disclaim, I'm not an investment advisor, I'm not an insurance broker, I'm not giving anybody licensed financial advice. I'm just telling you about a really cool concept that I was exposed to around a decade ago, a little over a decade ago, that I've been using and to very cool effect in my own life. But anyway, so you use whole life insurance and you put your cash into it and it accumulates cash value. It's not like term life insurance where it has no value unless you die and then you get, whoever the beneficiary is gets a bunch of money. With whole life, there's this cash value that accumulates inside the policy. So at any time that you need money, you're paying for life insurance anyways. And so let's say you've been paying for this life insurance for 2 or 3 years and you've got $20,000 in cash value in the policy. Then at any given time, if you need a loan for $20,000, you go borrow the $20,000 out of the policy. But here's the deal. You don't have to put up your house. You don't have to put up your car. You don't have to put, a CD or a certificate of deposit, put any cash on hand. You don't have to set up a margin account. You don't have to use any of the traditional collateral instruments because it's a life insurance policy and it's supposed to pay out some money if you die. And, worst case, the life insurance company says, okay, well, if you default on the loan, then we cancel the policy and we don't, we save ourselves all the money when you die. Or if you keep up the payments on the loan but you never pay it off, then when you do pass away 10, 20, 50, 80 years from now, whatever it is, we're going to owe your beneficiaries a bunch of money, so we'll be able to just pay ourselves back out of that. So it's cool. Technically, I don't want to say you're off the hook because like any loan, you really should pay it back. But there's nothing of yours in your physical life that they can come take if for some reason you were forced to default on the loan. So that's kind of the basics of how it works. I don't know, if you go online, they'll tell you some cons about it. I don't even necessarily want to list the cons. I mean, they'll tell you like, well, the rate of return on the whole life policy is lower than other types of investments, or they'll tell you that, well, whole life is more expensive than term life insurance. So if you're just measuring it purely based on the cost of insurance, then it's not as good a value as term life insurance. But I don't think those are even relevant cons because those aren't the point. The point is, of course, it's more expensive because you're putting cash in you can take back out. And of course, it pays out a lower return than other types of investments because it's 100% guaranteed. It's 100% zero risk, or 0% risk, I should say, which actually brings me to the first point that I want to talk about, which to really understand the value of this method, you have to understand a little bit about risk. Typically in business or in investing, risk correlates to potential reward. So if you want to make 100% return on your money, where you put in $100 and a year later you get out $200, you're probably going to have to take some really significant risk to try to go for that return, like maybe start your own business and hope that it's wildly successful. On the flip side, if you don't want to take any risk, you should expect a very low return. You can go put money into a savings account where it's guaranteed by the FDIC if you're in the United States, the Federal Deposit Insurance Commission Corporation, some word that starts with C. And they'll guarantee your deposit up to $100,000, so you have zero risk. But it only is going to, even in a savings account or a money market account, or even in a 12-month CD, you're going to make like maybe 1%, maybe 2% if your bank's really aggressive. So when you look at the rate of return, you have to also look at the risk. And so these whole life policies, and I have 5 of them myself, so just sharing personally, I have 5 of these different policies, and I earn anywhere between usually about a 5 or 6% dividend across the board on the cash value of these policies with absolutely zero risk. Now, there aren't that many investments you can make where you're able to earn 5 or 6% without any risk, and it's tax deferred. So you don't even have to pay income on that return as long as it builds up inside the policy until much later when you take it out. So, again, and I don't want to get bogged down into too much, nuances of investment, but basically, of all the vehicles that I've looked at, I haven't found anything that gives you this kind of rate of return, this kind of tax advantage with absolutely zero risk. Even when even real estate has the risk of going down. These life insurance companies that do these types of policies, they haven't missed a dividend. The grade A ones, the ones you want to use, they literally haven't missed a dividend, a lot of them, in like 100 or 200 years. You can't say that about almost anything. Even the government defaults on debt all the time. These insurance companies, they never do, right? Now, the second principle that you really have to understand this infinite banking concept is compounding versus ARR, or annual rate of return. See, a lot of people, traditional investment advisors and financial planners, and if you go on The Motley Fool or you watch the TV shows with the talking heads that talk to you about what to do with your money, they're really hung up on rate of return, and they'll bring on guys and say, this guy's had a 15% rate of return, or this stock is average, or this mutual fund has averaged a 18% rate of return over the last 5 years or whatever. And that's cool, that's important. But the thing you got to understand is rate of return is a deceptive metric. And I'll give you an example. So let's say you have $100 and it goes down 10% in the next year, right? So how much do you have now? You have $90. And then the next year after that, it goes up 10%. So it goes from 90, 10% of 90 is 9, so it goes back to 99. So after 2 years, you would say, oh, we had an average rate of return of 0. We were flatline, right? We weren't up or down. Except wait, you lost $1. $100 turned into $99, even though it went down 10% and up 10%. See how that works? Average rate of return over a period of years is a deceptive metric because it doesn't actually tell you how much money you made or lost. That's the difference between compounding, which is a consistent rate of return, and average rate of return, which is what a lot of money managers talk about. Compounding always goes like this. So Einstein called compound interest the 8th wonder of the world. And what he said, I'm going to mess up his quote, but basically he said, he who understands it earns it. He who does not understand it pays it. This is partly just because of the natural inflation of the money supply over time, but basically money is decreasing in value but increasing in quantity year over year. So there's this natural cost to just being alive where you're essentially paying compound interest even if you don't understand it. So you've got to get something in your life that puts a significant compound interest curve into play in your own life, honestly, just to stay even, much less to get ahead. And that's the power of compound interest, is that A, it makes sure that you stay at or above inflation over time. You don't have these dips. Remember Warren Buffett's number 1 rule of making money is don't lose money. And his number 2 rule is refer back to the first rule, don't lose money, right? Average rate of return is deceptive because it doesn't count the step back that you take when you lose money. In terms of calculating the average, you can make it up in a good year, but in terms of actual dollars, you never really make back up that ground when you lose money. A compounding vehicle guarantees that you never lose money. So when you take risk-free returns of, let's say, 5 or 6%, coupled with the fact that it's compounding, not average rate of return, now you're really, really putting some power into your personal economy, which is the next thing that I want to talk about, is your personal economy. So when I talk about this concept of personal economy, basically what I mean is inflows and outflows. Inflows and outflows. We get paid, however you get paid. If you own a business, if you have a job, whatever you do, maybe you got $5,000 a month comes into your personal economy, $5,000 a month goes out of your personal economy. You got to pay rent, you got to pay utilities, you got to pay for your car, you got to pay for your kids' school, you got to pay for your kids' braces, you got to take your husband or wife out for a date every now and then, whatever it is, right? That's your personal economy. And so there's a concept that we talk about in financial planning called savings rate, right? Like, what percentage of the money that flows through your personal economy do you actually save and invest? And you know, the first thing we look for is forced savings of like, I'm going to save 10% of the money that comes into my personal economy, I'm going to force into a savings vehicle, right? You have those automated transfers between your checking and your savings account that you can, you know, pre-schedule. But the next level is forced investment. That's what's so cool here is you can set up forced investment, not just forced savings, where you say, okay, 10% of all the money that flows into my economy, my personal economy, I'm going to force out into the cash value of one of these life policies. Which you could do that. You could force it into a mutual fund. You could force it into real estate. You could force it into stocks. You could force it into anything you want. But why wouldn't you? Why wouldn't you force it into real estate? Because what if you need the money? What if something happens and you need the money? What if you decide that, you know, what if your kid turns 16? I have two boys. One of them turned 16 last year. Bought him a truck. What happens then? Oh, I need the money back. What are you going to do? You got to sell the house, or you got to take out a loan against the house if you were able to buy real estate. Or let's say you have a stock account. What are you going to borrow against the margin? Like, if your forced investment vehicle goes into something that's not liquid, then in order to get the money back, if you need it, you have to sell it. So a lot of us, we resist doing that because of risk. We don't want to force investment money into something that could go down, and we don't want to force investment money into something that we would have to sell if we needed the money back. Whole life deals with both. Zero risk, powerful compounding growth curve over time, and you can take a greater percentage of the money from your total personal economy and force it into this, because if you ever have an event where you need the money back, you can borrow it back without collateral. Remember, the collateral is the death benefit. The collateral is literally based on worst case scenario, you didn't even have to deal with this until you die, and we'll take the money out of our own money that we were going to give to your estate or to your beneficiaries. I hope that's making sense. So think about most people, like the savings rate in the United States, at least, most of my data is US based. The savings rate is like abysmal. You know, the average person, if they save any money, saves like 1% of their personal economy. Well, imagine how much more you would feel confident in saving if A, you knew that every bit of forced savings was an investment that was going to grow guaranteed, compounded with no risk. And B, you knew that if you really needed to get the money back, you could. So a much greater percentage of your personal economy can actually go into investing where it can work for you when you know that you can get the money back and there's no risk. So think about this, think about the math. We're talking about the power of compounding, but when we talk about compounding or rate of return, we're typically talking about only the rate of return on the money that you invest. So if you're only investing 1% of the money that comes through your personal economy, well, no wonder we're obsessed with rate of return. We're trying to pay for our whole retirement. We're trying to build our entire nest egg and create wealth off of growth from this tiny amount of the total money that comes through our personal economy, because most of it's going out to bills, right? Well, if I'm having to try to grow a multi-million-dollar retirement based on investing only 1% of what I bring home in pay, you can understand why I'd be obsessed with trying to get 20, 30% a year returns. But if I'm able to, let's say, invest 20% of what I bring home, so out of that $5,000 a month, I can put $1,000 back into cash value whole life policies, because I know if I need it, I can get it back. And now essentially the amount that's compounding in that scenario is 10 times more than it would have been if I was only saving 1%. So this concept of understanding your personal economy, the inflows, the outflows, and of what comes in, what's able to go out into a place where it's still safe, but it can actually grow. And the more you can invest, the less you need really, high growth numbers on that base investment. In other words, it's better to earn 5% a year on 10% of all your money than 20% a year on 1% of your money. Hopefully that makes sense. Now let me give you a quick example. I mentioned that last year my son, turned 16, bought him a truck, right? How did I pay for his truck? Did I go get a car loan? Well, no, because for the last 10 years, I've been able to take between 10 and 20% of all the money that comes through my personal economy, which it doesn't really matter what it is. There's different policies and different policy values that can scale for different levels of income. But I've been able to pump that back into essentially an account that's growing at least 5% a year, that has no risk of ever going down, has never missed a dividend in 200 years across, I use 4 different life companies, and that I can borrow the money out anytime I want at an interest rate lower than or as low as what I could get from a bank if I was pledging my house as collateral. So when it's time to buy my son a car, I just borrow the money from my bank. And do I pay it back? Yes. In fact, what I do is I do what a bank does. I borrow the money at, I think the loans are between 4 and 5% interest, and I pay myself back just like I would a traditional bank loan. I actually structured it as a 5-year amortizing loan, and I pay myself back at 8%. So my bank is actually making a 3% yield on the money because it's pulling it out at between 4 and 5 from the life company, and it's getting paid back at 8, which I would have to do anyways if I borrowed the money from a bank. Only now if I miss a payment, they're not going to come take the car, and the excess interest that I pay back into my bank, instead of that being profit for a bank, it's profit that gets reinvested through what's called a level up mechanism inside the policy to actually pay for more insurance and increase the size of your bank. This is ridiculous. This is ridiculous. I encourage you, this is one video. There's no way I could give you all the information about this concept in one video. Go research the infinite banking concept. This is mind-blowingly cool. And here's the last thing I'll say about it to really hopefully seal the deal. And I don't have a vested interest in this. I'm not an insurance guy. Legally, I can't get a commission if you decide to do this. I'm just sharing this because it's freaking awesome. But here's the thing I'll tell you. So banks and financial institutions have something called Tier 1 capital. This is the capital that they have to keep on hand. They cannot put it at risk, because if they put it at risk, then the Federal Reserve, who actually loans them the money to loan out to their customers, the Federal Reserve can actually pull their credit line if the bank's Tier 1 capital goes down. So first and foremost, banks have a certain amount of money that they have to protect, or else the entire bank itself is at risk. 25%, the single largest chunk of all Tier 1 capital across all U.S. financial institutions, guess what it's invested in? It's invested in these policies. It's invested in whole life policies. Sometimes they'll buy pools of whole life policies from other insurance companies, but they want to stick that capital, and we're talking about what banks do with their most precious money, the money that's at the core of their entire business. What do? And why, as individuals, wouldn't we want to learn from what literally multi-billion dollar capital pools do with their money that they can't afford to lose, but they don't want to squander or waste the opportunity? See, this is money that they can't afford to lose, but it also drives them nuts that they can't loan it out. Because what do banks do? That's their business. If they have money, they want to loan it out. So how do they earn the greatest possible rate of return on money that they can't loan out and they can't take any risk with? They do this. If it's good enough for them, it's probably good enough for you. I know it's good enough for me, all right? I hope this has been informative for you. Thanks so much for your time talking about infinite banking. If you've tried this, or you're interested in this, or you have any thoughts on this, or you think it sounds ridiculous, whatever the deal is, leave a comment below. I want to hear your thoughts on this. And if you like this kind of stuff, please subscribe to my channel. I love sharing this with you, and I'll look forward to seeing you on future videos. Take care.